Have you ever watched your investments drop and felt your stomach sink instantly? That quiet panic creeps in, whispering that you are about to lose everything. You refresh your app again, hoping the numbers magically return to safety. But instead, the red gets deeper, louder, and harder to ignore. In that moment, logic disappears and fear begins making decisions for you. You start questioning every choice you made, every risk you ever took. Was investing even the right move or just a costly mistake? What if the market never recovers and this loss becomes permanent? These thoughts don't just stay in your mind. They follow you everywhere. They sit beside you at dinner, distract you at work, and steal your sleep. And suddenly, investing feels less like opportunity and more like emotional torture. But here's a question most people never stop to ask themselves honestly. What if the real problem isn't the market dropping, but your reaction to it? What if stress isn't coming from losses, but from misunderstanding how markets behave? Because the truth is, market drops are not rare or unusual events. They are predictable, recurring, and deeply embedded in how investing actually works. Yet nobody teaches you how to emotionally prepare for those inevitable moments. Instead, you are told to invest, grow wealth, and trust the process blindly. But trust without understanding creates anxiety, and anxiety leads to poor decisions, and poor decisions often cause more damage than the market ever could. Think about the last time you saw your portfolio decline significantly. Did you feel calm, confident, impatient, or anxious, fearful, and reactive? Most people fall into the second category without even realizing it. They believe they are rational investors but act emotionally under pressure. This gap between intention and behavior is where stress begins growing silently, and over time, that stress can push you to abandon your long-term strategy. You might sell at the worst moment, locking in losses permanently, or stop investing entirely, missing the recovery that almost always follows. So the real danger isn't the drop itself, but what you do during it, because markets recover, but missed opportunities often never come back. Now, imagine a completely different experience during the next market drop. Instead of panic, you feel calm, steady, and almost indifferent to fluctuations. You check your investments, not with fear, but with quiet confidence. You understand what's happening and why it's happening at that moment. And most importantly, you know exactly what you should do next. No guessing, no reacting, no emotional roller coaster controlling your decisions anymore. Just clarity, control, and a deep sense of long-term direction guiding you. This version of investing isn't reserved for experts or financial professionals. It's available to anyone willing to change how they think about market movements, because stress-free investing is not about avoiding drops entirely. It's about learning how to see those drops differently than most people do. And that shift in perspective can completely transform your investing experience forever. So before we talk about strategies, tools, or techniques, we need to reset something. We need to reshape how you emotionally interpret every rise and fall, because without that foundation, even the best strategy will eventually fail you. And with it, even simple approaches can create powerful, lasting results. So let me ask you one more important question right now. Are you trying to control the market, or are you trying to control yourself? Because one of those is impossible and the other changes everything completely. And once you understand which one truly matters, everything starts becoming clearer. That's where your journey towards stress-free investing actually begins today, not in charts, numbers, or predictions, but in your mindset first, because mastering your reactions is far more powerful than predicting outcomes, and that realization alone can save you years of unnecessary stress. So if you're ready to invest without fear controlling your every move, then you're about to discover something that most investors never truly understand, and it will change how you see market drops forever from this point. Let's move deeper into what's really happening behind those falling numbers, because once you understand that, the fear begins losing its grip completely. Let me tell you a story about two investors who started the same day. Both had similar incomes, similar goals, and nearly identical investment portfolios initially. They invested consistently every month, following basic advice found across financial platforms. For a while, everything seemed smooth, predictable, and even a little exciting. Their portfolios grew steadily, reinforcing their belief that investing was simple and rewarding. Then one day, the market dropped sharply without any clear warning signs. Headlines screamed panic. Experts debated outcomes, and uncertainty spread rapidly everywhere. Investor one checked his portfolio repeatedly, watching losses grow throughout the day. Each decline felt personal, like a direct attack on his financial future. He started researching nonstop, consuming negative news that amplified his anxiety further. Within days, fear convinced him that exiting the market was the safest decision, so he sold everything, hoping to protect what remained of his investments. Investor two also noticed the drop, but responded very differently. differently internally. He had seen this pattern before and understood markets move in cycles naturally. Instead of panic, he felt curiosity about what might happen next. He reviewed his plan, reminded himself of his long-term goals, and stayed consistent. In fact, he continued investing during the downturn without hesitation or fear. Months later, the market began recovering faster than most people had expected. Prices rose steadily, confidence returned, and opportunities became visible once again. Investor One watched from the sidelines, unsure when it felt safe to re-enter, but every time he considered investing again, prices seemed already too high, so he waited longer, hoping for another drop that never came quickly. Meanwhile, Investor Two benefited fully from the recovery and growth that followed. His portfolio didn't just recover, it grew stronger than before the downturn. Now here's the important part: most people tend to overlook completely. Both investors experienced the same market conditions and faced identical external situations, but their results were dramatically different because of one critical internal difference. Their understanding of market behavior shaped every decision they made under pressure. Investor One believed drops were dangerous signals that something had gone terribly wrong. Investor Two understood drops were normal phases within a long-term growth journey. This difference in interpretation created entirely different emotional and financial outcomes eventually. So the question becomes, which investor do most people unknowingly become over time? The uncomfortable answer is that most people act like Investor One, not because they lack intelligence, but because they lack proper perspective. They enter the market expecting consistent growth without interruptions or uncomfortable volatility. And when reality doesn't match expectations, stress begins taking control immediately. But investing was never meant to feel smooth or predictable every single day. It was designed to reward patience, discipline, and long-term thinking over time. Short-term fluctuations are simply the price you pay for long-term potential growth. Yet nobody emphasizes this enough when people first start investing their money. Instead, attention focuses on returns, strategies, and timing the market perfectly. But timing the market consistently is something even professionals struggle to achieve, and chasing that idea often leads to frustration, confusion, and emotional exhaustion. So instead of trying to predict every movement, something more powerful exists. You can design your approach in a way that reduces emotional pressure significantly. This begins by accepting that drops are not interruptions but essential components. They create opportunities to buy valuable assets at lower prices over time, but that opportunity only exists if you are mentally prepared to handle it. Otherwise, fear pushes you away right when opportunity is closest to you. Think about how this applies to your own experiences with investing so far. Have you reacted based on fear or followed a clear, consistent plan? Have your decisions been driven by headlines or by long-term understanding and patience? Because those answers reveal more about your future than any market prediction. The market doesn't reward knowledge alone. It rewards behavior under pressure consistently. And behavior is shaped by what you believe about how investing actually works. So if your beliefs are flawed, your results will reflect that eventually. But the good news is that beliefs can be changed and strengthened over time. And once they shift, your entire investing experience begins changing as well. This is where stress starts losing its power over your decisions gradually, because clarity replaces confusion and confidence replaces fear-driven reactions completely. And that sets the stage for a much deeper. Now here's where everything you believe about market drops starts shifting dramatically. What if market drops are not the problem, but actually part of the solution? That sounds counterintuitive, maybe even uncomfortable, but stay with this idea briefly, because this single shift can completely transform how you experience investing forever. Most people see falling prices as losses, danger, and signals to retreat immediately. But experienced investors often see those same moments as rare opportunities quietly appearing. The difference lies not in intelligence, but in how they define value itself. Let's break this down using something simple and relatable from everyday life. Imagine your favorite store suddenly offering everything at a significant discount: clothes, gadgets, essentials, all priced lower than they were yesterday. Would you panic and run away, or feel excited about the lower prices? Most people would feel thrilled, knowing they can buy more for less money. Now, apply that exact logic to investing, where assets suddenly become cheaper. But instead of excitement, people feel fear because money is already involved. That emotional attachment flips flips the reaction from opportunity into perceived danger instantly. And that's the hidden trap most investors never realize they're falling into. They treat lower prices differently, depending on whether they already own something. If they don't own it yet, lower prices feel like a gift. If they already own it, lower prices feel like a painful loss. But in reality, the underlying value of strong investments hasn't changed overnight. What changes is the market's temporary perception, influenced by countless external factors. So the real question becomes, are you reacting to price or understanding value? Because price moves constantly, but value tends to grow over longer periods, and confusing those two creates unnecessary stress that clouds your judgment repeatedly. Here's the deeper insight that changes everything for long-term investors. Market drops are the mechanism that allows wealth to transfer patiently over time from those who react emotionally to those who remain disciplined and consistent. It's not about predicting when drops happen or avoiding them entirely. It's about positioning yourself to benefit from them instead of fearing them. That means shifting your role from a reactive participant to a strategic observer. Instead of asking, why is this happening to me? Ask something more useful. Ask, how can this situation actually work in my favor right now? That single question redirects your focus from loss to a potential opportunity immediately. And once your focus changes, your emotional response begins changing as well. You stop seeing red numbers as threats and start seeing them as signals that the market is offering something valuable at a temporary discount. But this only works if you've prepared yourself mentally before the drop happens, because during the drop, emotions rise quickly and logic struggles to keep up. Preparation creates distance between what you feel and what you choose to do, and that distance is where better decisions are made consistently over time. So instead of fearing volatility, you begin expecting and even welcoming it occasionally. Not because losses feel good, but because you understand their long-term role. This doesn't mean blindly buying everything during every market decline without thinking. It means having a clear framework that guides your actions regardless of emotions. A framework built on understanding, patience, and realistic expectations about market behavior. Once you have that, drops lose their power to control your decisions. They become events you navigate, not crises that force you into action. And that shift alone removes a massive amount of stress from investing, because uncertainty feels less threatening when you understand what's actually happening, and confidence grows when your actions align